Hello, everybody. It is, according to my watch, 12:30 Chicago time, which means either good afternoon or good morning, depending upon exactly where you are. This is the 8th installment of the HMB SALT Group's webinar series. Today's webinar is Recent SALT Trends and Developments for Pass-Through Entities. So for those of you who have attended one of our webinars previously, thank you and welcome back. For those of you who have not had the chance to attend a webinar previously, welcome. We're glad you can join us. I know many of you are probably still working from home, and it's nice that you're able to find some time in your day to spend time with us as we talk about some of these current issues and trends in state and local tax. I'm David Hughes with HMB, and I am joined today by Samantha Breslow, who is one of the league leaders in HMB webinar appearances. Sam is making her third appearance in the webinar series. And then straight up from AAA, we called up a rookie, Fred Marcus, the M in HMB, who will be joining us today for his first webinar. So we have a good lineup. Housekeeping things before we get into the substance. So first, and maybe most importantly, we know a lot of you are attending in order to get CPE and CLE credit. So you will see 2 polling questions during the webinar. If you could please answer so that we can confirm that you actually attended, and that way we can issue the CPE and CLE. That's number 1. Number 2 is we also have a survey, and we appreciate it if you would complete the survey at the end of the webinar. We take them seriously. In fact, today's webinar on pass-through entities is a product of some recommendations from prior surveys for prior webinars. So we do take them seriously. We are going to do others. This is number 8, as I said. We are going to have number 9. We're going to have number 10. We're not entirely sure when, sometime soon. Check our website if you would like some information. And we might even do 11 and 12, et cetera, depending upon the recommendations you make in the survey. Finally, we have a Q&A button and a chat button at the bottom of your screen. So if you have comments or questions, please feel free to use one of those 2 buttons. We will monitor them during the webinar, and we will do our best to answer them during the webinar. If we don't get to them during this hour, we will try our best to respond to you offline. So with the housekeeping out of the way, Sam, if you want to go to the agenda, thank you. So we have 6 topics that we're going to try to cover over the next 57 minutes. Sam's going to start with nexus and doing business for flow-through entities. I'll jump in and talk about credit for taxes paid to other states. Fred is going to handle the apportionment of partnership income. And then I'll jump back in and talk about some of the SALT cap deduction workarounds that apply to flow-throughs. There are some specific Illinois issues we thought you should know about. Sam's going to handle that. And then Fred will wrap up with the discussion of new partnership audit rules. So that's our preview. I'm going to get out of the way and let Sam take over from here.
Sorry about that, I muted myself. Welcome again. And as Dave mentioned, the first issue we're going to get into is doing business and nexus issues in the context of flow-throughs. This first section is going to be very California heavy, and it's because California has been really active with respect to this issue. Some of you may be familiar with this SWORT decision, and the idea behind it is if an LLC or a partnership is doing business in the state, are its members or shareholders doing business in the state? So SWORT was decided in the California Court of Appeal back in 2017. In that case, it was an Iowa corp that operated a farm in Kansas that acquired a 0.2% interest in a manager-managed LLC that was doing business in California. So the issue is whether that ownership interest can render the corporation to be doing business in the state via its ownership interest. And the Court of Appeals said, no, you're not doing business because that 0.2% interest is not enough to have any sort of control. It's very minor, it's passive. And for those reasons, you're not doing business in the state. And the court didn't ultimately get to any sort of constitutional issues in SWORD, due process, or Commerce Clause because they ruled on statutory grounds. And what does the FTB do? Well, just a month later, in February of 2017, in an FTB notice, they come back and say, well, okay, we'll apply SWORD, but only in situations with the same facts. So the FTB sort of cuts off SWORD and its applicability, and that leads to this SAFU decision in September of 2018, which is a non-precedential opinion out of the Office of Tax Appeals. And in that case, you have a 25% interest, so much more than the 0.2% interest in SWORD. Instead, you have a 25% interest, but it's still passive. It's still a non-managing member interest in an LLC. And the issue is whether, again, that constitutes doing business in the state. And the court says that it does, that it does not. That 25% interest is not enough to constitute doing business in the state. And then we have this interplay with the FTB again, where the FTB just a month later issues legal ruling 2018-01, where they say that, okay, well, if an LLC is doing business in California, its members are generally considered to be doing business, but a narrow exception may apply in limited circumstances. So they are really trying to limit the applicability of SAFU. They're saying, well, I don't know if we're going to apply that 25% only in really limited circumstances. So you have this funny interplay between the FTB, the Office of Tax Appeals again, and the Court of Appeal. And just sort of give you a little bit of background about how they all work together. The Office of Tax Appeals was created in 2017. It's an independent appellate forum. And the idea is that their opinions are guiding, but they are not precedential unless someone requests that they are. And any person can propose that an opinion be precedential. Versus the Franchise Tax Board, when they issue their legal rulings or their notices, like the two I mentioned, the idea is that that's their position. It's kind of the equivalent to an IRS revenue ruling, and they consider it to be their opinion in a litigation position. So that's sort of setting the framework. And then we have 3 more decisions out of the Office of Tax Appeals related to the same issue, taking similar but different positions. So the first one is the Jolly decision in 2019 in July. So you're going to see we have one in July, August, and then November. So Jolly is the only one so far that is currently precedential. And in that case, you have Jolly owns between a 1.12% and a 4.75% interest in an LLC that's operating in California. And again, the issue is whether that means they're doing business in the state. And rather than focusing on the bright line standard that we got into in SWORD with the 0.2% or the bright line in SAFU with the 25%, the court instead rejects both of those and it says instead that we're going to conduct a fact-intensive inquiry. Instead, we're going to look at the relationship between the out-of-state member and the in-state LLC to make that determination. And they say that there's just not enough evidence here that Jolly had any ability or authority to directly or indirectly influence the management or operation of the LLC. So not doing business. Now, the OTA is tested again a month later in Wright Capital Holdings. And in that case, they own a 50% interest. So getting greater again. And in that case, again, they apply the fact-intensive inquiry set forth by Jolly and say that the taxpayer just didn't provide any evidence here that they didn't have the ability to manage or control. So they are doing business in the state. So the question that we kind of get out of Wright is, would we have a different decision if it were a manager-managed situation? And there was some sort of evidence that they lacked control. So that's sort of a pending question. And then the last one here out of the Office of Tax Appeals is LCP holdings, and they really break the trend here. Instead of getting into the either the bright line standards set forth by Safdie or Swart or the fact-intensive inquiry of Jolly, instead they get into really a different test, which is whether the pass-through receipts exceed the bright line standard in the state of California. Because if you look at California statute, section 23101, there's two subsections, right? So there's subsection A, which says that a business is doing business by actively engaging in any transaction for the purpose of financial or pecuniary gain. And that's what Safdie and Swart and Wright and Jolly, that's what that's all getting at. But they say, we're gonna do this under subsection B, which has the bright line threshold of $500,000 worth of sales, $50,000 worth of property, $50,000 worth of payroll. And under that bright line standard, their flow through receipts from their interest in the manager managed LLC, that exceeds $500,000. So they are doing business in the state. So what's our takeaway? Well, this question is still clearly not very resolved. We have, I think, going forward, our only presidential opinion, or our most recent presidential opinion in Jolly, sets forth this fact-intensive inquiry. So that's really the question: is you need to focus on how much control do the members actually have, or the managers have, over the business and their ability to make decisions. That leads us to another related issue in California, which is the minimum franchise fee. I know a lot of people have probably dealt with this minimum franchise fee. It can sort of catch you by surprise if you didn't know that you need to pay the minimum tax. So the California statute specifically says that a disregarded LLC must pay the $800 annual tax and file the returns. But it doesn't say anything about disregarded limited partnerships. So at issue in this is whether a disregarded limited partnership is required to pay the minimum fee. And here you have one regarded partner, all the other partners are disregarded. So for federal tax purposes, the partnership's disregarded. California follows the same treatment, so also disregarded in California. I won't get into more into the details, but again, at issue is whether a limited partnership that's disregarded is required to file and pay the minimum franchise tax. And the court says no. So we have sort of a refund opportunity here, where maybe if you were previously paying the minimum franchise tax as a disregarded limited partnership, you might not need to pay. But the FTB did subsequently issue Notice 2019-06, where they set out steps for how a limited partnership can get that refund. And there is a little bit of work involved. You have to file a certificate of limited partnership, provide the partnership agreement, provide an organizational chart, the federal returns, and include a declaration by the general partner stating that the entity is disregarded for federal income tax purposes. So there is a bit of work that goes along with that. And then we have another recent decision related to the minimum franchise fee in Pund, and out of the California Office of Tax Appeals. And at issue in that case is, they have an LLC that registered with the Secretary of State back in 2012. They don't do anything in the state in recent years, and then they don't pay the minimum franchise tax. And in 2016, the question is whether they are required to pay it because they have not filed a certificate of cancellation with the state. And I think it's a pretty clear decision. I think they reached the right decision here, which is that every LLC, including a single member LLC, is subject to the LLC annual tax and is required to file unless you file that certificate of cancellation with the Secretary of State. So nothing too surprising, but I think it could catch a lot of LLCs or pass-through entities by surprise if you're thinking, well, we're no longer operating in the state, we don't have to pay this, but you do, if you were registered with the Secretary of State, you do in fact have to file that cancellation. So those are our big doing business nexus questions. And Dave is going to take us into credit for tax paid to other jurisdictions. So Dave, you have a client that's an owner of a pass-through entity, and he's paying tax in every jurisdiction where the pass-through entity is operating. Is your client going to get a credit to his state of residency for the tax paid? Oh, Dave, sorry, you're muted.
Sorry, we have a problem with the pesky mute button. I heard the question though, and the answer is maybe. Before we get to the answer, there was a question from the audience about whether this webinar will be recorded. And the answer is, much like the old baseball games I've been watching on TV during the pandemic, this webinar will also be available on YouTube. So you can watch old baseball games and our webinar. It'll be on YouTube by the end of the day tomorrow. But in response to the question that Sam raised, does a flow-through owner receive credit for taxes paid to other states? All joking aside, the answer is maybe. And we have to look at this first in terms of tax paid by the individuals themselves, not by the entity, but by the individuals. And there's two cases that we want to talk about. Now, before getting into either of these cases, keep in mind that 4 years ago, I think it was, 5 years ago maybe, the US Supreme Court issued a decision in the Wynne case, W-Y-N-N-E. And that's a super important case in this area. And basically what the Supreme Court said in Wynne was that, and this was a situation where the Wynnes were owners of a flow-through, they were Maryland residents, they were paying tax in other states as a result of the operations of their S-Corp in these other states, and they were getting a credit for Maryland state-level income tax, but they were not getting a credit against the Maryland county tax. Maryland counties have the ability and authority to impose income tax. So they were getting a credit, some credit in Maryland, but not entirely. And what the US Supreme Court said is, look, Maryland, you're basically taxing those people like the Wynnes who are operating an S-Corp that operates both within and without Maryland. You're taxing them more than you're taxing the business owners who operate only in Maryland. So you're essentially discriminating against those businesses that choose to operate outside Maryland. And the Constitution, Commerce Clause says you can't do that. So that's the background, at least to this first case, the Steiner case. This is a case out of Utah. It was decided August of last year. The Steiners, like the Wynnes, are business owners, a business that operates in multiple states, and in this instance, operates internationally as well. And the Steiners were paying tax not only to other states, but they were paying tax to foreign countries on their business operations overseas. And they wanted a Utah credit for the taxes they were paying to other countries. And the Utah Supreme Court said, no, we're not giving you that credit. And I think a lot of people, might agree with the ultimate decision on the grounds that the taxes that the Steiners were paying overseas were national taxes, federal taxes, and not what we call subnational taxes, state level taxes. So you might be able to rationalize the decision, but it's how the Utah Supreme Court got there that is troubling to a lot of people. The Utah Supreme Court said that the Foreign Commerce Clause applies only to C corporations, that it doesn't apply to individuals. And that's kind of a head scratcher. And we've never seen another court say that. And I think a lot of people were expecting the US Supreme Court to hear this case in light of some of the comments made by the Utah Supreme Court, but the US Supreme Court did not take the case. So at the end of the day, we have a situation where Utah residents are not getting a Utah credit for taxes paid to foreign countries. They get the credit for taxes paid to other US states, but not to foreign countries. I don't think this will be the last word on this. I think there will be other cases arising in other states, and maybe someday the US Supreme Court will take a case like this. But But it's a bit of a frustrating decision given how the Utah Supreme Court framed its decision. The other case here is the Murawski case. It's a recent case out of California. This involves something called a reverse credit. So this is something that Virginia has. The Murawskis are California residents who own an S Corp that does business in Virginia. They pay tax, the Murawskis themselves pay tax to Virginia, and they wanted a credit on their California return. Well, Virginia is a state that has one of these reverse credits, which means that a non-resident like the Murawskis doesn't have to pay tax to Virginia. They can effectively claim a credit in Virginia as long as they pay tax to their home state, in this case, California. Well, the Murawskis didn't do that. They just decided to pay Virginia and claim the credit in California. California said, we're not giving you a credit for the tax you paid to Virginia, because you didn't have to. You didn't have to pay that tax. And so we're not going to give you a credit. So the Murawskis lost out in that situation. Sam, if you want to go to the next slide. So those two cases we just talked about are situations where the individual flow-through owners paid an individual income tax somewhere else, in foreign countries in the case of the Steiners, or to Virginia in the case of the Murawskis. The next several cases concern whether individual owners are entitled to a credit in their state of residency for tax paid by the entity. So whether they get a credit for entity level tax. And there are at least two states that recently have said that those residents can claim credit. So the first one is Louisiana. This is the Smith v. Robinson case. This is a situation where the taxpayers were owners of a flow-through that operated in Texas. The flow-through paid the Texas franchise tax, basically their gross receipts tax, and they wanted a credit. Now, Texas doesn't have an individual tax, of course. So the Robinsons wanted a credit in Louisiana for the tax that the entity paid in Texas, and the Louisiana Supreme Court said, sounds good to us, give them a credit. And the decision was based in large part on the Wynn case from the US Supreme Court, where the Louisiana Supreme Court looked at this and said, you know, if we don't give these guys a credit, they're going to end up paying more tax than the Louisiana business owner who operates only in Louisiana. So if you compare the two, then it looks like the Robinsons end up paying more tax if they don't get the credit in Louisiana than the owner who operates only in Louisiana. And I don't know if that's true when you think about it, because again, here the tax was paid at the entity level in Texas. It wasn't paid by the individuals. In Wynn, the tax in the other state was paid by the Wynns individually. So again, not sure the analysis is right, but at the end of the day, the Supreme Court in Louisiana allowed the credit. Massachusetts came out with a statement recently, which we're going to touch upon later in the webinar. Massachusetts came out with a statement recently that says Massachusetts residents do get a credit for an entity level tax paid in Connecticut. Connecticut has a new entity level tax on pass-throughs. Massachusetts says you get a credit in Connecticut, basically because the Connecticut tax is a net income tax, which is significant because when you go to the next slide, Sam, we're going to see two situations where states did not allow a credit for an entity level tax paid. The first is the Goggin case out of Maine. Pretty straightforward. LLC pays the New Hampshire business profits tax. Maine residents want a credit for that tax. The Maine Supreme Court says no, because they say the credit provision is premised on the individual paying the tax, not the entity. So the Goggins did not get their Maine credit for the New Hampshire tax paid by their LLC. And then the other one, the last one, the most recent one, just came out, what, about 6 weeks ago, the Lowry case out of Massachusetts. So here's Massachusetts again in the same situation as we saw on the previous slide, except this time Massachusetts, the Appellate Tax Board, says no credit. Mr. Lowry was a partner in KPMG. KPMG itself paid the Texas margins tax. Mr. Lowry wanted a credit for that, for his share of the Texas margins tax paid by KPMG. He wanted the credit on his Massachusetts return. Massachusetts said no, in large part because they viewed the Texas margins tax as a gross receipts tax, not as a net income tax. So on the previous slide, we saw this announcement about the Connecticut tax. Massachusetts is allowing a credit for the Connecticut tax paid by the entity because the Connecticut tax is a net income tax, whereas the Texas tax is a gross receipts tax. So Mr. Lowry lost out on his credit in Massachusetts. It's an appellate tax board decision, so maybe there's going to be an appeal. One of the big issues with partnerships is, segueing to the next slide, is how do you determine a partner's share of a partnership's income? So Fred, you want to jump in and take over on that?
Yes, I can, and I did remember to unmute my computer.
Fred's winning so far.
Yeah, one of us did. That's good.
There are two methods that I really want to talk about. What you see on this particular slide is the approach that various states take. I'm going to use Illinois as the example, and I'm going to suggest to you that it's probably a good recitation of what the general rule is, depending on whether you're dealing with a unitary partnership or a unitary relationship between the partnership and the partner or partners, or you're dealing with a non-unitary relationship where the partner is merely, I guess, a partner in a non-unitary partnership. So let's start with business income. If we're dealing with a non-unitary partner and the partnership has business income, how is the non-unitary partner going to reflect that on its individual return? So again, business income, and what they're going to do, or what they're going to be required to do, and again, I'm using Illinois as the example, is the partners, the individual partners' percentage distributable share of the partnership's business income is going to be required to be apportioned to the state by the partnership based upon the partnership's apportionment factors, and on the partner's return, it's allocable to the state to which the partnership apportioned the income. It is not, and this mistake is often made, it is not going to be included in the partner's income or apportionable tax base and then reapportioned as a result based upon the individual partner. And we're assuming it's a corporate partner, but based upon the individual partner's apportionment percentages. So again, very simply, what the partner does is he or she or it picks up its distributive share of the business income of the partnership and then reallocates that income to the state to which the partnership, which the partnership apportioned the income. If we're dealing with non-business income, again, what the partner is going to do is pick up its distributive share of the partnership's non-business income, and then it's going to allocate it to the state to which the partnership's non-business income was allocated. Very simply, it's going to follow what the partnership did. So again, if the partnership has allocated that non-business income to a specific state, the partner is going to pick up his or her or its distributive share of that non-business income and specifically allocate it back to the state to which the partnership allocated that income. Let's talk about a unitary partner. I'm doing this, I guess, in reverse order, but be that as it may, that's how I'm going to do it. Again, unitary partner, and let's again draw a distinction between business income and non-business income. Simply stated, a partnership must use the combined apportionment method if it's engaged in a unitary business relationship with one or more of its partners. Now that raises kind of an interesting question, which we've seen at least at the corporate level. there are some states that are going to require a single unitary return to be filed, and there are other states which are going to require the partnership to file its own return, and then the individual partner or partners to file their returns. But they're all going to be based on the combined apportionment method. And when you use the combined apportionment method, what the partner does is it picks up his or her or its percentage distributable share of the apportionable business income and factors of the unitary partnership, and includes those numbers, that income and those factors in its calculation of its own base income and its own apportionment factors, applies the apportionment factor to its apportionable business income, and then comes up with a number that becomes ultimately its taxable income. And again, very simply, what's happening is that its distributive share of both the income and the factors of the partnership are picked up by the individual partner and apportioned on a unitary basis. Now, it's kind of, it's not really unfair, but what's going to happen if that unitary partnership has non-business income? That non-business income, again, is going to be picked up by the partner. If there's a single return being filed, it's really not going to matter very much, because that income is going to be allocated back on that particular return to the state or states to which that income needs to be allocated back to as non-business income. But if the partner files a separate return based upon a unitary combination, I'm going to again suggest that what's going to happen is that partner is going to pick up its share of the non-business income and allocate it back to the state to which the unitary partnership or the partnership has allocated that income. And I think that covers apportionment by both a unitary partnership and a partnership which does not have a unitary relationship with its partners. And let me make one more comment, because you're going to have LLCs. And the question there ultimately is going to become whether or not the LLC makes an election to be treated as a partnership or it's going to be treated as a corporation. If it's going to be treated as a partnership, its members, I'm going to suggest, are the partners, and they would have to follow these rules. If it's going to be treated as a corporation, it's a C Corp, and it's going to be taxed as such, and none of these rules are going to make much of a difference. So with that, let's move on to SALT cap deduction workarounds. And I believe, Sam, that's yours.
Well, it's
Was it
mine.
My mistake.
Well, but Sam, one of our perceptive audience members asked about the polling questions.
Oh, good point.
Are they? Do you have to do that manually now?
Yeah, we'll do our first one now before we get into the SALT cap. Well, actually, I'm gonna.
Do you want me to do this and then you do it?
We'll do the second one because it actually goes hand in hand, Dave, with the credits that you were just discussing recently. So the first polling question that we're going to do is, have you or your client been denied an individual income tax credit for entity level tax paid to another jurisdiction? I'm going to give this just a few more seconds to get the responses in. And by the way, if any of you are having issues with the polls, this is generally caused by whether you have, you're utilizing Zoom through the online platform, if you downloaded it to your desktop. if you're having any issues, feel free to reach out to us or to Hillary, who handles all of this, and she will make sure that you guys get your CPE credit. So don't worry if the polls aren't working. We have encountered this with prior webinars, so don't worry about that. Okay, so I'm going to share the results. So have you or your client been denied an individual income tax credit for entity level tax paid to another jurisdiction? Most people are saying no, they are feeling lucky. So have not dealt with that issue, but a substantial portion also think that there might be a future filing issue.
Yeah, it is a mix, and we saw a mix of authority, so not surprised that there are some yes answers.
If I may throw something in here, we're actually currently working on somewhat of a complex issue, but it's a voluntary disclosure issue for a partnership that's operating in maybe 25 or 30 states. And the issue that has popped up, to the extent that the entity is filing at the entity level in these states, and the individuals are also filing returns in these states, what they have been doing is they've been reporting 100% of their income to Illinois. The partners are Illinois residents, and they too have been reporting the income on their Illinois returns. So the question that we've posed, which we're now pursuing, is whether or not, to the extent that we do a voluntary disclosure in these 25 states and pay tax, both at the entity level and the individual level, will Illinois, which has a tax or imposes a tax, grant these individuals a refund for the taxes that were paid in the 25 additional states that we've just done or are in the process of doing a VDA in. Our belief is that Illinois will, but that remains to be seen. We'll see whether or not they raise one of the issues we discussed earlier.
Yeah, and Illinois allows the credit to the extent the tax is paid at the individual level. If the tax is paid at the entity level, then Illinois is likely not going to allow a credit.
That's my understanding of what will happen, but we're going to request both and we'll see what happens.
Mm-hmm.
Which is a good segue into the next topic, SALT cap deduction workaround. So little background, I think most of you are probably familiar with this, but back in 2017, the Tax Cut and Jobs Act imposed a $10,000 limit on the SALT deduction for individuals on the federal return. There is no SALT deduction cap for businesses. So this is a provision that significantly impacts individuals, especially business owners who might be paying a lot of individual income tax in multiple states. So what a lot of states, not a lot, what some states have done to try to lessen that blow a little bit is they have adopted entity level taxes so that instead of paying tax at the individual level, the flow through, the pass through now pays the tax itself. And then the individual just simply gets to claim a credit against what would otherwise be their own individual tax. So it's a way to shift the tax to the entity because the entity can then deduct it for federal purposes. So there are 7 states that have done this. Connecticut was the leader, and their entity level flow through or pass through entity tax is a little bit different than some of the other states. First, the Connecticut tax is mandatory. So pass-throughs in Connecticut have no choice. They have to pay the tax. And then the individual owners get a credit equal to 87.5% of their distributive share, of their share of the tax paid by the pass-through. So that's Connecticut. There are 6 other states that also have an entity level tax: Louisiana, Maryland, New Jersey, Oklahoma, Rhode Island, and Wisconsin. Those are elective, so the pass-through doesn't have to pay the tax. It's up to the entity and their owners. And then there are some other pending bills that might make the same change. Alabama, Michigan, and Minnesota all have pending bills. Arkansas had one, but it did not pass. So we'll see if it ultimately passes in Arkansas, but it did not pass the first time through. So what are the takeaways from this? So I think there's several things to think about. One is whether it's these states that have already adopted a pass-through entity tax, or states that might adopt one down the road. First, is the tax mandatory or elective? Connecticut, it's mandatory. You don't have a choice. In the other states, it's elective. You know, maybe the biggest question here is whether the IRS is going to sign off on this, because we saw with another, well, again, in response, I guess, to the SALT cap deduction, we saw some states allow for contributions to a charitable organization set up by the state. We saw states set this up to give taxpayers the opportunity to increase their charitable deduction and then take that as a credit against state income tax. IRS said you can't do that. That's a quid pro quo. They wouldn't allow it. The IRS has not yet said that this pass-through entity workaround is not acceptable. So we have reason to believe, maybe hope to believe, that the IRS is okay with this, but it is something to watch. Another thing to watch is how much of a credit do you get? So in Connecticut, we see that the owners get a credit equal to only 87.5% of the tax paid by the entity. In other states, it's 100%. Can you carry forward any excess credits? That's something else to watch. And then maybe, to me, maybe the most interesting thing, because this dovetails a little bit with what we were saying before, is whether a non-resident owner will get a credit for the tax paid by the entity. So two states have already addressed this. One is Massachusetts. We saw that announcement earlier, where Massachusetts had said that, yeah, to the extent that the entity pays the tax in Connecticut, Massachusetts will give a Massachusetts resident a credit for their share of the tax paid by the entity in Connecticut. The other state that has said, yes, we'll give a credit is New Jersey. So New Jersey has also said the same thing. The condition or the caveat in New Jersey is that the entity level tax paid in the other state has to be similar to the New Jersey tax. So New Jersey has a net income tax. So I think what New Jersey's getting at is the problem that we saw in that other Massachusetts case where the partner from KPMG tried to take the credit, is if the entity is paying a tax in a state that is not a true traditional net income state, it's a gross receipt state, it's the Ohio CAT, it's the Washington B&O, the Texas margins tax, whatever it might be, then New Jersey is suggesting that the owners will not get a New Jersey credit for that. So that's it on the workaround. Sam, I think there's some interesting stuff in Illinois if you want to jump into that.
I guess before we move to Illinois, you know, it's interesting that the most recent one here, Dave mentioned, is Maryland. So that was just recently adopted in May. So I'm curious to see whether more states follow down this path, because this is definitely a new hot issue.
Yeah, and so, yeah, along those lines, yeah, watch Alabama, Michigan, Minnesota. You know, those might be the next three to watch, because those are the ones where the bills are still pending and are still in process.
Yep. Before we do, I want to get our second and final polling question out of the way, so I don't forget later on. So let me cue this up here for you. All right, so our question is, have you attended any prior H&B webinars? And as Dave mentioned at the beginning, we received a whole lot of requests for partnership pass-through entity issues. So curious to see if we have a lot of repeat offenders here. I'll give it 5 more seconds here. All right, so 37%, this is their first, and 54% have attended at least one. So yeah, it looks like a lot of people are here specifically for partnership issues, so good. All right.
Who's the individual who asked if this was even a webinar?
Yeah, I like the sense of humor. Okay, so we're gonna move into Illinois partnership issues. So yeah, we received a lot of requests for us to do a webinar on pass-throughs, and we also received some requests specifically for Illinois issues. So we wanted to make sure that we did touch on that. This first issue, the Illinois reasonable compensation, excuse me, personal services deduction, is an issue that Dave and I have seen a whole lot recently, both within audit and in litigation. We have dealt with a lot of taxpayers who took this deduction in full, kind of zeroing out their income, and then now are being audited by the state with respect to the issue. But to give you a little bit of background before I delve into it, so Illinois is a little bit different than a lot of states in that they impose a personal property replacement tax on partnerships, S corps, at a rate of 1.5%. They also impose it on C corps at a rate of 2.5%. And the idea behind this deduction is to allow partnerships and LLCs to be on equal footing with corporations that can deduct compensation paid to a shareholder or employee for services rendered to the corporation under IRC 162A. So you have this replacement tax on the entity, but this deduction is supposed to somewhat make it fair for partnerships and LLCs. The replacement tax has been in effect since 1979, but really up until recently, there has been limited to no guidance with respect to how this deduction works. So the statute says that the Illinois Income Tax Act allows partnerships and LLCs to deduct from base income any income of the partnership which constitutes personal services income as defined by this section of the IRC, which is repealed, or a reasonable allowance for compensation paid or accrued for services rendered by the partners to the partnership, whichever is greater. So this is an or, you get whichever is greater. But what does this mean? So again, up until recently, we had a ruling or two that really didn't provide a whole lot of insight, really no case law. And in January of 2019, Illinois did enact regulations that Dave and I were just talking about this morning, how helpful they really are. They're certainly better than nothing, but there's still a whole lot of big question marks here. I'm going to do my best to try to explain, what I think these two terms mean: the personal services income versus the reasonable allowance for compensation. So the first, personal services income, again, is defined by this repealed section of the Internal Revenue Code. And if you look to that section of the Internal Revenue Code, it says that it includes earned income. And then if you keep chasing down the definitions of the IRC, earned income, it means net earnings from self-employment income. So one of the arguments that we have made repeatedly within audit and litigation is, to the extent that you are paying or treating it as self-employment income on line 14 of your federal Schedule K-1, you should be entitled to a deduction for personal services income on your Illinois 1065. We've had some success with that argument. I won't say it's a slam dunk, but it's certainly been successful. Another argument that's had success is deducting guaranteed payments. So you should be at minimum entitled to deduct any guaranteed payments as personal service income. Now, what about a reasonable allowance for compensation paid? What does that mean? Well, generally the idea behind it is if you had to hire a third party to do that same role. So let's put this in the context of a real estate management firm, which Dave and I are dealing with one of those right now. So the idea being, how much would you have to pay a third party to perform those same services that the shareholder or member is performing? Commonly what we'll do is look to competitors, look to a similarly situated business, and to the extent that information is available as to how much they're paying that person in a similar role, use it to your benefit. Pad your books and records. So if you are audited on this issue, you have some sort of basis for it. But it's still a difficult argument because not every business is the same. Not every person is playing the same role. So it's tricky to be able to justify what a reasonable allowance is. Dave and I have seen in the context of real estate management firms that the department was for a while giving out sort of a blanket 5%. It looks like they've even sort of changed their tune with that. That's no longer guaranteed. We've seen more favorable. We've seen them given 0. So it's not really guaranteed either way. I will say that I think your better case scenario here would be more of a service-based business, right? So if you have a business that operates in some sort of services, like an architecture firm or a law firm, it's much easier to prove how much their time is worth, either on an hourly basis, or to argue that what their product is are those services. So that is what's generating the income of the business. The harder argument, on a sliding scale, would be a manufacturer of goods, or really the hardest would be the real estate management firm that we referenced, because there the department frequently takes the argument that it's the real estate that's generating the income, not the services of the partners or members, even though we know that no average Joe can do that job. There is clearly skill and there's time involved with making sure that they're investing in the correct properties. So but that's nevertheless one of our harder arguments. So just wanted to make you guys aware of this issue. It's certainly hot button. We have seen it a lot, really probably starting maybe about 3 years ago. We saw this seems to be on the list of the department's issues that they really want to target. So feel free to reach out. We do have a couple blogs, articles online that we can also pass around on this issue if you're interested and want to follow up. Dave, before I move on, I don't know if you had anything else you wanted to say, because I know you've been involved with this issue as well. Okay. And I'm going to touch on investment partnerships quickly, because I want Fred to be able to get into the new partnership audit rules. So yeah, the idea behind Illinois investment partnerships, so generally distributions to a non-resident partner are treated as non-business income. And they're allocated either, if it's an individual, to the partner's state of residence, or in the case of some other person, like a business or corporation, would be allocated to the commercial domicile. But non-resident partners can elect to treat the distributions as apportionable business income, or if the income is from investment activity that meets several qualifications, then it's also treated as apportionable business income. One of those is if the income is directly related to any other business activity conducted in the state, or a second one is if it serves an operational function to any business activity of the non-resident partner, or finally, where the assets of the investment partnership were acquired with working capital from a trade or business activity conducted in the state in which the non-resident partner owns an interest. So if any of those factors apply, then it's also going to be treated as apportionable business income. Just sort of want to make you aware of, Illinois, unlike a couple other states like Kentucky and Virginia, do have a statutory definition for what an investment partnership is. States like Kentucky and Virginia look at the nature of the income or the assets, versus Illinois has this 90% rule, which I won't get into, but happy to discuss afterwards. But just sort of wanted to put investment partnerships and Illinois' rules on your radar. So go ahead, Dave.
Yeah, sorry, Sam. Before we get to Fred's section on audits, and I do want to save some time for that because it's important, we had a question come in from the audience. So if we can spend a minute addressing the question, which I'm going to paraphrase. The question is basically, if you have an Illinois LLC that owns a 1% interest in a partnership that operates in California, is that Illinois LLC considered to be doing business in California? And my take on it, and this, Sam, goes back to the cases you talked about at the outset on California. Based on those cases, don't get caught up in ownership percentage. Yes, it's relevant, but the more relevant question is, how active is that out-of-state owner, in this case, the Illinois LLC? How active is that owner in the operations of the California business? Because even if it's a 1% owner, if it's an active owner, if it has the authority to control and to manage the business, then yeah, I think it's going to be doing business in California. But if it's passive, if it's really just an investment, then no, it's not going to be doing business. And I'm not sure the ownership percentage really matters at that point. So yes, it's a relevant consideration, the ownership percentage, but ultimately it's about the degree of control and involvement that the owner has in that California business.
Yeah, I agree, Dave. Ms. Swartz and Satview, they were focused on those bright line thresholds but that's sort of gone the wayside now with the Jolly case and what they call a fact-intensive inquiry. So, right, it's more about how much control do you have over the direction of the LLC or the
Yeah, and we had two more questions. We're going to answer those offline. So we want to save time for Fred to do his audit rules. So the other questions that have come in, we will answer those offline.
So I will handle this pretty quickly in light of the fact we only have theoretically 4 minutes left. Partnership audits. There are really just two things I wanted to talk about. I think the slide is self-explanatory, and it certainly tells you, it gets into the states in which the MTC model statute was passed, where it's pending, and where it did not pass, which is Kentucky. And then it also talks about states which have passed legislation which doesn't follow the MTC model statute, that being Arizona, Hawaii, Maine, and Rhode Island. But I wanted to get into what the problems may be. If you remember, under the old procedure, and that was under TEFRA, if there was an assessment or an audit at the partnership level, I'm talking about on the federal side, that was then moved down to the individual partner level, and it was the individual partners who were assessed and who could contest that liability. Well, under the Bipartisan Budget Act, that's all changed. And now what's happened is that the individual partners do not or no longer have the right to contest an audit or an assessment at the partnership level. And I'm going to suggest that at the partnership level, depending on whether you're dealing with a partnership or an LLC, which has its members and a managing member, either in an LLC, it's the managing member, or if we're talking about a partnership, either the general partner, the tax matters partner, or a partner who might be appointed by the partnership ought to be handling the audit. And once that has occurred, and once the audit is complete, it is that individual who can represent the partnership before the IRS and ultimately the state in dealing with the assessment against the partnership. The other thing, and again, the difference being that under the Bipartisan Budget Act, the individual partners are no longer, or they no longer have the ability to contest an audit that's occurred of the partnership or an assessment of the partnership level. The other thing that I'd watch out for involves the sale of a partnership. And I would almost at this point in time look to it as if you were engaged in the sale of a corporate entity. And that would require consideration to be given to a number of issues in the distribution, or excuse me, in the sales agreement. One of the things that you need to look out for is who is going to be responsible for any tax that's assessed against the partnership under this new regime. So if you're the buyer, you're certainly going to want to include something in your purchase agreement which dictates who's going to be responsible for any tax that's assessed against the partnership for years prior to your acquisition. And I think that's very important, and it's really no different than it would be if you were handling it for a corporation. If you're the seller, well, let me talk about the buyer. One other thing that I think you need to take into consideration. To the extent that there's an audit of the partnership and you're the buyer, do you as the buyer want to have something to say about how that partnership is handled, or whether or not the prior partnership, so to speak, or whomever's responsible for handling the audit is required to contest the audit? You might want to take that into consideration, because if you don't have a provision that speaks to who's responsible for any tax for the prior owners or prior partners, then you certainly are going to want to have something to say about whether or not you can step in and defend against any assessment that may be imposed. If you're the seller or the buyer for that matter, what about the costs that are associated with the audit? Who's going to be responsible for that? That's another thing you have to take into consideration if you're engaged in the purchase or the sale of a partnership or a partnership interest. So those are kind of some of the things that pop out as a result of this new regime with respect to how audits are conducted and who's responsible for any additional tax that may be imposed against the partnership. Because again, the partnerships have nothing to say about it. So with that, I think we're out of time basically. And I will turn it back over to either you or Sam, either you or Dave.
Since I actually have my microphone unmuted, I will jump in if that's okay, Sam. Anyway, thank you, everybody. We hope you enjoyed this. If you have a few minutes, yeah, please complete our survey. We take them seriously. We want to know what else you want to hear about in future webinars. Along those lines, please check our website. Please check your inbox. We will have more webinars. We will announce those. We're glad you could join us today. And stay well, stay healthy, and enjoy the rest of the summer. Take care. Bye-bye.